So that's business combinations. Now we'll look at how do we account for income taxes for tax consolidated group. So UIG 1052 basically requires bottom-up calculations. When groups, I've seen ways different groups perform their tax effect calculations. There are groups which in the past did their calculation on a consolidated trial balance basis, but they found that it then created a lot of, difficulties when they tried to work out the appropriate unders and overs or tax expense or DTA and DTL for their subsidiary entities, trying to reallocate them. So basically, US 01052 requires a bottom-up calculation. So that with UIG 1052, when you do your calculation, so you start with the head company, it calculates its CTL, it calculates its income tax expense, its DTA and DTL on temporary differences, and DTA on losses and credits. So these balances in the head company stays with the head company. For a subsidiary though, it does its own calculation, so it has its income tax expense, deferred tax assets and liabilities on its temporary differences, and deferred tax asset on its losses, if relevant, and its current tax liability in its trial balance initially, if relevant. But what happens under UIG 1052 is that it requires the CTL immediately on recognition to be transferred to the head company. So you can see here, CTL needs to be transferred to the head company. Same thing with DTA and DTL. Sorry, same thing with DTA on losses and credit. That gets transferred to the head company. Why? I guess it is a head company that pays the tax to the ATO, so it should sit in the head company. And it is the head company that utilizes those losses, so it should stay with the head company. This transfers stays with the head company even if the subsidiary is subsequently sold or exits the tax consolidated group. So when you have a CTL of a subsidiary that is transferred, so if you see in your mind, the subsidiary has a CTL, it needs to debit that CTL. So the question is, what does the subsidiary credit? Okay, so you might already know the answer in your mind. If you have a tax funding agreement, I encourage companies to put in place a tax funding agreement. The other side goes against the intercompany loan account. If you don't have a tax funding agreement, when you debit the CTL or credit the CTA, you will need to create a fictitious equity entry. Okay, so there will be a fictitious share capital account entry or a dividend paid entry. And this creates a confusion, and I would encourage companies to put in place a tax funding agreement. And it helps in getting a clean exit when your subsidiary is sold in the future. So as I mentioned, you do your calculation on a bottom-up basis. UIG 1052 just says that you might consider these three methods, but it's not compulsory. The three methods is, the first one is a standalone taxpayer approach. And the standalone taxpayer approach basically says, assume you're not part of the tax consolidated group and account for taxes as though you're not part of the group. So if you sell to another member of the group, you still recognize the tax on that sale. A small variation of that is a separate taxpayer within the group approach. So this method basically says, do your calculation as though you're not part of the group. However, if you have a transaction with a member of the group, you can ignore that for tax purposes. So if you sell to another member of the group, you don't tax effect that sale. Our preference is to use the first method because it provides a more better reflection of the tax position on its economic results for that entity. The last one is a group allocation approach. And really, to apply this method is really one of these. You reasonably allocate the balances, but you really have to use one of this method here. Okay. So a quick example here is actually, I might skip this example. There's a video in relation to the prior TEA seminar, which I will send you, as I'd like to leave some time for questions.